Welcome to Tax Smarts Unlocked, the podcast for individuals and small business owners looking to conquer the tax landscape with confidence. Hosted by seasoned tax professional David Robson of Premier Tax and Business Services, each episode is packed with insightful advice on proactive tax planning to help you navigate the complexities of tax laws. Here's your host, David Robson.
Welcome to Tax Smarts Unlocked. I'm David Robson, your guide to keeping more of what you earn with proactive tax planning. Today, we're navigating the Qualified Business Income Deduction, or QBI, under Section 199A. If you own a pass-through business, this may be a sizable deduction, but only if you know the rules. I'll demystify who qualifies, how it's calculated, where the limits are, and practical, year-round moves to maximize it without stepping on rakes. QBI is a deduction of up to 20% of qualified business income from pass-through entities, sole proprietorships reported on Schedule C, partnerships, S corporations, and certain trusts and estates. It is taken below the line after adjusted gross income, and it does not require you to itemize. There's also a separate 20% component for qualified RA dividends and traded partnership income. Combine those pieces, then apply a cap tied to your taxable income. Equally important is what QBI is not. It excludes capital gains and losses, dividends, and most interest that isn't properly allocable to the trade or business. If you're an S corporation owner, your reasonable compensation is not QBI. Partnerships, guaranteed payments to partners are not QBI, and wages you earn as an employee never count. QBI is about business profit, not portfolio income or compensation for services you pay yourself through payroll or partnership agreements. Here's the big picture. Compute QBI separately for each trade or business. Net positives and negatives across activities. Apply any prior year negative QBI carry forwards, then add RET and PTP components. The combined deduction is generally 20% of that figure, but it can never exceed 20% of taxable income after subtracting net capital gains. So even profitable businesses can see the deduction squeezed if taxable income is low or capital gains are high overall. Thresholds matter. For 2025, the phase-in begins around $197,300 of taxable income for single filers and $394,600 for married filing jointly. Below the range, most businesses simply get the 20% subject to the taxable income cap. Inside and above the range, two additional rules appear: the W-2 wage and property limits, and restrictions for SSTBs, specified service trades or businesses such as health, law, accounting, consulting, financial services, athletics, and performing arts, plus reputation-based businesses. Above the top of the phase-in, non-SSTB businesses face the wage and property test. Your QBI deduction is limited to the greater of, first, 50% of W-2 wages paid by the business, or second, 25% of those W-2 wages plus 2.5% of the UBIA, unadjusted basis immediately after acquisition, of qualified depreciable property in its depreciable period. This encourages payroll and investment, and it's why wage timing and asset purchases can affect your deduction. SSTBs, think doctors, lawyers, accountants, consultants, financial advisors, performing artists, athletes, face a tougher rule. Within the phase-in range, the deduction is reduced by a formula. Above the top of the range, the QBI deduction for an SSTB disappears. That's a cliff. If you're close to the threshold, tax planning to reduce taxable income can preserve all or part of the deduction. If you're above, focus on non-SSTB entities, retirement, and capital gain management to improve outcomes. Rental real estate can qualify as a trade or business, but facts matter. The IRS safe harbor requires 250 hours of rental services, records, and separate books for each enterprise, with an option to combine similar properties. Self-rentals to a controlled operating company usually qualify even if the tenant is an SSTB. Be cautious with triple net leases. They often fail the trade or business test unless you provide services or elect to properly aggregate them. Aggregation can be powerful. If you own multiple controlled businesses with the same tax year that meet relatedness tests and show common ownership, you may elect to aggregate them for 199A. Aggregation can help meet W-2 wage and UBIA limits by pooling payroll and property. It requires a statement with your return listing entities and facts, and once elected, you must continue consistently unless circumstances change. Good documentation front avoids headaches during an IRS exam. S corporation owners must pay reasonable compensation for services before profits flow as QBI. Too low invites penalties. Too high erodes the deduction because owner wages are not QBI. The art is setting supportable salary that covers duties, while leaving profit as pass-through. Document duties, time, comparable salaries, and profitability. Remember, W-2 wages still matter for 199A limitation, so an appropriate salary can satisfy compliance and support the wage-based cap when you're over the threshold. Thoughtful W-2 planning moves the needle. Consider timing year-end bonuses so they're paid within the tax year when wage limits apply. Evaluate onboarding employees versus contractors, but never misclassify. The 199A benefit isn't worth payroll tax penalties. Use a payroll provider that reports 199A W-2 wages by EIN and entity, and reconcile reports to your books. If you operate multiple entities, coordinate payroll so wages land where they support the limitation and align with reality. UBIA planning is about timing and title. To count for the 2.5% factor, qualified property must be owned by the entity, acquired by purchase, and placed in service by year-end. Bonus depreciation or Section 179 expensing does not reduce UBIA because the base is unadjusted. Ensure assets are titled to the right entity and placed in service, delivered, installed, and ready for use before December 31st. Consider cost segregation to identify components and strengthen documentation for purchases. Retirement and health moves interact with QBI. SEP, Simple, and 401k contributions made by the business reduce business income and therefore reduce QBI. Yet they also reduce taxable income, which can increase the taxable income cap or keep you under SSTB thresholds. Self-employed health insurance reduces QBI, while HSA contributions reduce taxable income without touching QBI. Model the trade-offs. The blend can lower tax and preserve a percentage deduction, especially when you're straddling the phase-in range. Don't ignore the taxable income cap. Because QBI cannot exceed 20% of taxable income minus net capital gains, one stock sale can shrink your deduction. Consider timing gains across years, tax loss harvesting, or donating appreciated securities. Bunch deductions by accelerating expenses or stacking charitable gifts through a donor-advised fund. Above-the-line deductions like HSAs and IRA contributions can help. The goal is to land taxable income in a sweet spot that maximizes QBI and savings. QBI doesn't let you cherry pick. A loss from one business offsets income from others when computing the deduction. If your QBI goes negative, you get no deduction this year and carry the negative amount forward to offset future positive QBI. That carry forward doesn't reduce taxable income. It only reduces QBI for 199A. Track losses by activity so you know what's being netted and consider whether separating or aggregating activities changes the interaction in your favor. Documentation wins audits. Save payroll reports that show W-2 wages by EIN and by entity, tie them to filed W-2s, and reconcile to the books. Maintain UBIA schedules listing cost, placed in service date, asset description, and remaining depreciable period. For rentals, keep safe harbor logs, service hours, and evidence of separate books. If you aggregate, include the required statement annually. Review K1s for 199A detail codes and reconcile them to your records so nothing gets missed. Common pitfalls, a few standouts. Misclassifying partner payments as QBI when they're guaranteed payments. Forgetting that owner-employee S corporation wages are never QBI. Failing to track UBIA, placed in service dates, and depreciable period, which collapses the property factor. Ignoring aggregation opportunities that would solve wage or property limits. Overstating or understating S corporation reasonable compensation. Missing the SSTB cliff by a few dollars of taxable income because no one modeled year-end moves. Each can cost money. Quick cases. 1. A consulting S corporation near the threshold. We staged charitable gifts into a donor-advised fund, maxed a solo 401k, and deferred a gain, preserving a deduction. 2. A manufacturer above the range. We timed year-end bonuses, shifted a contractor to employee status, and placed equipment in service, boosting the wage and UBIA limits. 3. A landlord. We documented the safe harbor, matched service hours, and used self-rental rules to an operating company. Your year-end checklist. Run a Q3 and Q4 projection. Set S corporation reasonable compensation. Review payroll versus contractor mix. Consider equipment purchases and in-service dates. Finalize aggregation elections and confirm rental safe harbor records. Adjust retirement plan and contributions. Look at capital gains and charitable timing. Take a multi-year view. Section 1999A is scheduled to sunset after 2025 unless extended, and states vary on conformity. Model entity choice and investments with that horizon in mind. That's a wrap on navigating QBI. We covered what counts, what doesn't, the wage and property limits, SSTB cliffs, rentals and safe harbors, aggregation, S-corporation pay, wage and UBIA tactics, retirement and health interactions, managing the taxable income cap, loss carryforwards, documentation, pitfalls, and case wins. A plan can turn confusion into cash. If you're serious about keeping more dollars, partner with a tax professional. I'm David Robson. Thanks for listening to Tax Smarts Unlocked today.
Thank you for joining us on Tax Smarts Unlocked, the ultimate podcast for individuals and small business owners ready to conquer the tax landscape with confidence. Hosted by seasoned tax professional David Robson of Premier Tax and Business Services. Each episode has been carefully crafted to provide you with insightful advice on proactive tax planning. By adopting a smarter tax approach, you can focus on what you do best, growing your wealth and your business. We're here to guide you every step of the way. Don't miss an episode. Subscribe to Tax Smarts Unlocked on your favorite podcast platform and unlock the secrets to confident tax planning. Remember, it's time to take control of your taxes and unleash your full financial potential.